Hi friends, welcome back to Murthy Finance Academy. Today we will discuss some key players from EMS sector. The first one which company which we are going to discuss today is Kaynes Technology India Limited. A quick disclaimer, I'm not a SEBI registered analyst. So whatever the companies I'm going to discuss are purely for educational purpose. Please do not consider it as an investment advice. Now let's back to the video. So Kaynes Technology has evolved into a formidable integrated electronics manufacturing player, strategically pivoting from traditional EMS provider to an end-to-end and IoT solutions enabled partner. In an industry where many players are content with low margin assembly, Kaynes has climbed the value chain into conceptual design and lifecycle support. Their current strategic focus is the aggressive expansion into high margin, technically complex moat businesses like semiconductor assembly and testing, OSAT, and high density interconnect PCBs, HDI PCBs. So, if you see its core business verticals, the first one is industrial, including EV, which is a growth anchor for the company, which generates nearly 54% of the revenue, and it is the highest revenue contributor, benefits from the sticky nature of industrial, IoT, and EV adoption. So, second segment is automotive. It is the core pillar, which contributes nearly 27% to the 9 months fiscal year 2026 revenues. Steady revenue flow, but currently seeing share compression as industrial is growing much faster. Third is strategic electronics, which is a margin booster, which nearly contributes 6% of the total revenue. This is involves in high complexity projects in defense, aerospace, and outer space with high entry barriers. The fourth segment is IoT or IT and other segments, which is a future tech, which nearly contributes 9%. This is offers emerging solutions and consumer integration, providing scalability and tech leverage. The last segment is medical and railways, which is a high reliability niche sector, which contributes nearly 4% to the total revenue. And here it provides critical infrastructure and healthcare segments where reliability dictates premium pricing. So while these capabilities provide a competitive edge, the massive shift toward capital intensive semiconductor manufacturing is now placing the company's execution capabilities under an institutional grade microscope. The broad macro landscape for Indian electronics is no longer just about assembling for the world, it is about designing and making in India. Supported by PLI schemes and Make in India momentum, the domestic electronics manufacturing sector is entering a structural bull run. So, according to data from IBF and MEITY reports, India's ESDM market is projected to reach 300 billion by 2026, growing at a CAGR of roughly 25 to 30%. So, here Kaynes is uniquely positioned to capture this TAM because it ignores the commoditized low margin consumer assembly market like mobile phones to focus on strategic electronics like defense, aerospace, and nuclear sector applications. These segments demand high precision and offer significantly higher gross margins than consumer electronics. However, this growth isn't free. The primary industry-wide headwinds remain global supply chain volatility and intense capital intensity required to compete with global semiconductor giants. So, Kaynes reported 22% year-on-year growth in Q3 fiscal year 2026 with 8,040 million. While seemingly healthy, this represents a cooling velocity compared to the 37% growth seen in the 9 months period. So investors must distinguish between order book growth and execution velocity. So the company's industrial, including EV segment, continues to dwarf others at 54% of 9 months revenue, followed by automotive at 27%. The order book has ballooned by 50% year on year, standing at a massive 90,722 million. So a 9,000 crore plus order book offers multi-year revenue visibility, especially de-risking the top line. However, it creates an enormous execution burden. If the company cannot convert this order book into billings efficiently, it risks becoming a victim of its own success through bloated inventory and rising financing needs. So for Q3 fiscal year 2026, the numbers reveal a classic divergence. The P&L looks robust, but the balance sheet is feeling the strain of rapid expansion. So In fiscal year 2026, it generated nearly 8,040 million, which grew by 22% year on year, and PAT by 24%, and EBITDA margin is reaching to 14.5% from 14.2%, and PAT also improved by 15%, reaching to 766 million. So while EBITDA margins expanded slightly by 30 basis points, the PAT margin eroded by 60 basis points. This was largely due to a 176% spike in tax expenses and an 89% jump in depreciation. The most alarming metric is the surge in net working capital days from 107 to 139. Inventory days have nearly doubled year on year from 73 to 139 days. This is a red flag. While management cites strategic stocking for the 9,000 crore order book, doubling inventory days suggests either an execution bottleneck or a significant cash drain. So for the 9 months fiscal year 2026 period, PAT stands at nearly 2,726 million, but the CFO to PAT ratio remains chronically low. And this divergence signals low quality of earnings. The company is booking profits on paper, but cash is being devoured by working capital and capex. Here, Kaynes is winning the growth sprint but losing the cash marathon. Profits are rising, but every rupee earned is being locked up in warehouses or paid to the taxman. The 139-day working capital cycle is eroding liquidity at a time when they need it most for expansion. Also, the company's asset turnover declined from 3.4 times to 2.3 times. This is the direct result of the 6.8 billion jump in gross block. The assets are on the books, but they aren't generating revenue at a J curve risk. And its net debt to equity ratio also improved to 0.1 from 0.2. So this is a byproduct of the 1374 crore QIP infusion and not organic debt repayment from operations. Also, the company's ROCE stood at 14.1 percentage and ROE at 12.5% are adjusted for unutilized QIP proceeds. If we include the idle cash, these ratios would look significantly weaker, highlighting the struggle to maintain capital efficiency during the capex surge. So, management's narrative of consistent quarterly performance needs a reality check. Revenue actually dipped 11% sequentially from 9,062 million to 8,040 million. This non-linearity suggests that the growth is lumpy and heavily dependent on specific project execution timelines. So the company's finance costs decreased by 8% year on year is a clear win, confirming that QIP proceeds were used to deleverage high cost debt. And OSAT promise. The company's shift to semiconductors, OSAT currently exists mostly as capital work in progress and depreciation. Until these facilities contribute to the top line, the AI of tech leverage is a promise, not a performance. So management is excellent at contract acquisition, but currently faces an execution gap. Using QIP money to pay debt was a smart defensive move, but the sequential revenue dip in Q3 proves that growth isn't not a straight line up. And if you compare its valuations, the company is currently nearly trading at around 66 PE with ROC of 14.3 and 5-year profit CAGR of 95.2%. But whereas its competitors like Sirma SGS and Honeywell and Aditya Infotech type of companies are trading nearly around 50 to 70s. At a PE of 66, Kaynes is one of the most expensive stocks in the sector. While the 95% 5-year profit CAGR is legendary, the current price to book multiple suggests the market is already pricing in the full realization of the 9,000 crore order book. The stock is in expensive territory. You are paying for tomorrow's profits today. Unless Kaynes maintains a 90% plus profit growth, the current PE of 66 times will be very difficult to defend if interest rates stay high or execution falters. Some key red flags are including promoter shareholding has dropped by 10.1% over 3 years, while QIPs are for growth. A consistent downtrend requires monitoring. And the company's working capital days also jumped to 139 days is a major capital intensity risk. A 3-year average return on equity of 11.3 is anemic for a company commanding a 66 times PE. And over 80% of revenue is tied to industrial or EV and auto segments. Any slowdown in Indian manufacturing would be a catastrophe. So if we see some basic SWOT analysis, the company's massive order book is with 90,772 million and 5-year strategic deleveraging with net debt of 0.1% and 95% 5-year profit CAGR are key strengths. Coming to weaknesses, 139-day working capital cycle, negative or volatile CFO to PAT ratio, and declining asset turnover are some key weaknesses. Coming to opportunities, OSAT or semiconductor first mover advantage, PLI scheme tailwinds, and ESDM market growth could be key opportunities for this segment, for this company. And intense peer competition from Sirma, Aditya Infotech, and other EDSM players is a key threat for this company. And depreciation and tax hitting PAT margins is also a key threat. And sequential revenue non-linearity could be a threat for this company. So what are some key monitorables to be tracked in this company? Are inventory liquidation must see a reduction in working capital days towards 100 within 2 quarters. And second is CFO recovery. Does cash flow from operations return to positive territory in the fiscal year 2026 annual report or not? We need to track. And OSAT commissioning. Execution timeline for the semiconductor facility delays will be punished by the market. And gross block utilization. Improvement in asset turnover from 2.3 times back towards 3 times. Fifth is interest coverage ratio, maintenance of reduced finance costs despite rising capex needs. Sixth, PAT margin recovery, reclaiming the 11% range seen in previous quarters. And seventh is order to bill conversion, monitoring the burn rate of the 90,000 million order book. And eighth is promoter stability, no further significant dilution below the 53% mark are the key monitorables to be tracked in this company. And if you see some latest news and events, Kaynes has utilized a bulk of its 1374 QIP proceeds compliantly with 367 crores as of December 31, 2025. This remaining war chest is critical for the upcoming semiconductor capex. Recent credit rating upgrades from ICRA and CRISIL also, by maintaining a stable outlook and acknowledging the improved capital structure post QIP, could be a catalyst for this company. So what is the bottom line? Kaynes is a high conviction growth story with a bloated balance sheet. For the retail investor, this is no longer a cheap entry. It is a play on management's ability to turn a massive pile of inventory into cold, hard cash. Hope you like this video. If you do like this video, please do like, share, comment, and subscribe to Murthy Finance Academy. Thank you.